Good afternoon, everyone. Welcome to today's webinar on the risks of aggressive tax planning. My name is Connor Weimer from the AFA Member Services team, and I'm delighted to be joined by over 300 members today in this webinar on the risks of aggressive tax planning, which is TPB CPD accredited. In line with our professional development program, we'll continue to do CPD accredited webinars, particularly for those members in regional areas. Today, the ATO will provide an overview of the tax avoidance schemes that are currently of most concern to the ATO. You have an important role as a trusted advisor to your clients, and this webinar will enable you to be aware of the schemes being promoted so that you can keep your clients informed. This will give tips on what to look out for and how to avoid being caught up with these schemes. We are really pleased to be working with the ATO on this, and we hope this opens up further opportunities to collaborate and bring future webinars on the topics that are most relevant to the discussions you have with your clients. We welcome member input on opportunities for future webinars on the specific areas relating to tax, including capital gains tax, the 2018 budget, and possible changes to franking credits should this occur down the track. Of course, we also welcome input on broader topics as well for future webinars. Throughout this webinar, please submit any questions you have in the Q&A box to the right of your screen, and these questions will be answered at the end of the presentation. Let's get this underway. I'm delighted to introduce Assistant Commissioner Patricia Sampathy. After several years as an Assistant Commissioner within public groups and international, Patricia Sampathy joined the private groups and high wealth individuals business line within the ATO and is currently Assistant Commissioner within the aggressive tax planning workstream. She leads teams who develop strategies to prevent aggressive tax planning, detect current risks, and engage purposefully with key agents and other intermediaries to curb community appetite for aggressive tax planning arrangements. Prior to joining the ATO in 2002, Patricia was a Senior Tax Manager at PricewaterhouseCoopers, and before then a Senior Lawyer within the Victorian State Revenue Office. Patricia completed an LLB in Melbourne and has a Master of Taxation Law from Monash University. Patricia is joining us from Perth today. Welcome, Patricia.
Thank you, Connor, and thank you, AFA, and a very good afternoon to all of you. The first thing I want to talk about is our relationship with intermediaries and what a great, important part of the tax system you are. So we recognise the crucial role that intermediaries such as yourself play in the Australian tax and super systems. And for some time now, our organisation has pursued a strategy of positive engagement with intermediaries. We do this to gain a critical leverage in our stated mission, which is to foster voluntary compliance and willing participation of all in our tax. Now, as financial planners, you, as you have said, are a trusted advisor providing expert services that help Australians and businesses succeed and are a very important intermediary to us. The ATO employs a number of strategies to prevent aggressive tax planning, detect current risks, and deal with breaches of governing regimes. Now, these strategies aim to protect the integrity of the tax system and to guard the community against unwittingly entering into aggressive tax schemes. While we respond firmly to these sorts of schemes through our compliance action, our primary focus is on prevention through education and early engagement. Our approach to aggressive tax planning risks is to act quickly. We want to stop the proliferation of potential tax avoidance schemes and to disrupt the model from both the supply and demand side for these products. Now, our research shows us that there are some commonly held community perceptions and attitudes to tax that influence taxpayer behaviour. So today I'd like to invite you to think about your role in changing these attitudes. In engaging with you in forums like these, we actually aim to help you and those you service recognise, reject and report tax planning arrangements that go beyond what the law intended. In doing so, we generate a level playing field for all of you. So what then is the difference between legitimate tax planning and aggressive tax planning? The difference boils down to intent. You are permitted to assist your clients arrange their financial affairs and maximise their investment outcomes in a way that is consistent with the intent of the law and in doing so, to keep their tax to a minimum. By contrast, aggressive tax planning schemes, rather tax avoidance schemes, notably those of an aggressive kind, involve the deliberate exploitation of the tax system. They frequently have little or no economic substance. They're often contrived, and they may even border on illegal. Such schemes are not confined to arrangements and products that are marketed widely to taxpayers. They also can be found in boutique, bespoke, or one-off arrangements. Someone deliberately designs them to avoid tax that is lawfully owed to the community. They increase the tax burden on compliant taxpayers and deny funds that contribute to the economic and social well-being of all Australians. So what are the risks? The risk of aggressive tax planning schemes for your client can include unwelcome attention by the ATO through tax audits, civil investigations where promotional conduct is involved, unpaid taxes, interest, and penalties. Courts have recently affirmed that penalties of a kind, or penalties that relate to civil penalties in particular, are meant to be struck at a level that sends a clear message to the community that they have a strong deterrent value. So apart from costly penalties for your clients, there can also be risks for your own reputation as a professional advisor through breaches of the applicable legislation and also breaches of professional standards that may be mandated by your association. Association with these sorts of schemes may also generate scrutiny from other regulatory bodies such as ASIC or the Tax Practitioners Board, and ultimately damage your long-term relationship with the client. So how then do you protect your clients, the clients of your practice, against aggressive tax schemes? We commend a good governance framework, which includes systems and controls to ensure the accurate reporting, identification, assessment, and management of your tax risks, including an evaluation of your exposure to a contravention of promoter penalty laws. This will give us, as a tax administrator, confidence that your tax affairs and that of your clients are under control, and that you and your clients are able to identify, assess, and mitigate tax risks, including aggressive tax planning. Now, we have a lot to say about governance on our public website, and I don't intend to repeat any of that here, but I would ask you to look at those sections which set out what we consider to be key principles of effective governance, notably those sections that are headed Recognise Tax Risk, Seek Advice, and those sections that are concerned with ethical and responsible behaviour. Also, I would ask you or suggest that you have a look at our recommendations for systems and controls that ensure accurate reporting and identifying tax risks, particularly risks of the kind that will attract our attention. Now, we have some particular suggestions for organisations such as yourself for protecting your practice from exposure to tax avoidance schemes. We suggest that you publicly disclose your tax advice services and tax products, provide detailed information about your products, marketing materials and processes, and use external intermediaries. We also ask you to ensure that the remuneration methods for tax advice services for members of your firm or employees and the fee structure for products of the firm do not generate an exposure to aggressive tax planning stances. We also advise or recommend that you have supervisory oversight of tax advice services for members of the firm or employees. How can you help the ATO? Now, to help us, it would be valuable to know from you, if you encounter this, who came up with the idea of a tax planning arrangement? In other words, the promoter. Who did the marketing and how did they get paid for this? The promoter is the person or the entity behind a scheme. They have a vested interest in securing you or your client's involvement in the arrangement and are generally quite active in marketing the arrangement, charging substantial fees and receiving a payment including commissions from your client's investment. In many instances, it may be you, the financial professional, who needs to deal with regulatory agencies and support your client's affairs when the arrangement falls over. Now, when a client approaches you seeking guidance, you may hear things like, I have been told that I can claim back heaps if I say I have R&D. I've been and seen another tax agent who has an R&D consultant they use. If a client comes to you with something that may cause concern, doesn't look or feel right, or appears too good to be true, it's really important to question it. We see your role as helping to protect your client and, by association, your business reputation from scheme promoters. So if you have clients who are caught up in an aggressive tax scheme, we really encourage you to engage early with us so that we can work together to resolve any problems. So what do you need to be looking out for when assessing an investment or tax arrangement to ascertain if there may be a form of aggressive tax planning or tax avoidance? Fortunately, the way these arrangements are structured, financed, and documented is often a real trigger to discerning professionals such as yourself. We ask you to be on the lookout for products that do not have a product disclosure statement or prospectus for the product, products which offer zero risk guarantees, structures that are set up to hide or disguise sources of income, arrangements that refer you to a particular advisor or expert. This may claim the advisor has specific knowledge about the arrangement and the promised tax benefits. We ask you to be wary of arrangements where you are asked to maintain secrecy to protect the arrangement from rival firms, or arrangements which discourage you from obtaining independent advice or getting a second opinion. Now, in the area of finance, there are certain red flags, as we say. Round robin financing, where the funds are passed through various entities and usually back to the initial entity. For example, the promoter lending you the money to invest in the product. Non-recourse loans that you don't have to repay if the investment goes bad. Complex financing arrangements involving limited recourse loans where your liability is limited to your share in the investment, and investments that are primarily funded through tax deductions, for example, by including substantial interest prepayments in a financial year. In terms of structures, we ask you to be prudent about any arrangement that involves deferring income to a later period so that the tax is paid in a later period too. Not declaring income or hiding income, for example, in an offshore location such as a tax haven. Changing the nature of income so less tax is paid, for example, changing capital expenses into revenue expenses. Changing private expenses into business expenses so that they can be claimed against income. Creating an entitlement to a tax offset or credit that wouldn't otherwise have been payable. Moving income to a trust or partnership to split it among people in a lower tax bracket so less tax is paid. Inflating or artificially creating deductions. Moving taxable income to an entity that is tax exempt or has a lower tax rate, such as a charity, a company, or a super fund. Or setting up a business for the sole purpose of obtaining tax benefits where there is no ostensible business purpose to the arrangement. Now we come to current arrangements of concern. Now, aggressive tax planning schemes seek to exploit the tax system by reducing or deferring assessable income, increasing or bringing forward tax deductions, and or inflating or creating tax credits and offsets. There are a number of schemes that are under our watch, with the following that I'm going to be talking a little bit more about, representing arrangements that are of current concern. 3 of these relate to retirement planning schemes and talk a little bit about split loans, the capital income issues arising from arrangements we're seeing in the healthcare industry, and unitisation in Division 7A. Moving to retirement schemes. Now, we're addressing a number of schemes increasingly used by promoters targeting Australians planning for their retirement. These schemes encourage individuals to channel money inappropriately through their self-managed super funds. We have launched Project Super Scheme Smart to educate taxpayers and their advisors about these types of schemes so they know what to look for. Now, the penalties are substantial for those involved in deliberate tax avoidance schemes of this type. And the penalties aren't just financial. An individual may very well lose their right to be a trustee of their own super fund, and in some cases, they could go to jail. We have encouraged many in the community to engage with us on our arrangements of concern, and promoters of these schemes are also on our watch list, and we have disrupted schemes designed to provide an unfair advantage. So the following are some examples of supersede schemes that are of current concern that are involving SMSFs. The first involves the granting of a legal life interest over business real property to a self-managed super fund. Now, these are arrangements where an entity or an individual purports to divert income from commercial property to an SMSF to minimize or avoid tax on their income. Now, this is undertaken by the individual entity and or SMSF by creating a deed granting a life estate interest over the commercial property to their SMSF. Now, we are concerned that this arrangement is being entered into in an attempt to divert rental income to a self-managed super fund, where the income is concessionally taxed or treated as exempt current pension income to avoid paying tax at the individual's personal marginal tax rate. So what does it look like? In the example, it reflects one or more individuals owns commercial property that comprises land and a building that is business property. It's leased to a tenant. The deed is entered into over the commercial property to their SMSF. The individual holds the remainder interest in the commercial property. Now, the self-managed super fund may use one or more of the following methods to acquire the life interest. They may pay for the life interest using existing fund resources, or the life interest is contributed to the fund by the member as an in specie contribution, or the avenue may be a limited recourse borrowing arrangement that complies with Section 67A of SISA, the Superannuation Act. Now, as holder of the life interest, the SMSF will be entitled to any rental income derived from the underlying commercial property. Self-managed super fund treats the rental income as concessionally taxable or as tax-exempt income. The income is either returned to the individual through a pension or reinvested to increase the member's account balances. When the specified person dies, the legal life interest is the full rights to use, and income returns to the title holder of their estate. Moving on. A second area of current concern relates to the refund of access non-concessional contributions to reduce taxable components. Now, these are arrangements where members deliberately exceed their non-concessional contributions cap for the sole or dominant purpose of altering the taxable and tax-free components of their super account balance. We are concerned that this arrangement is being entered into by individuals in an attempt to reduce the taxable component of their super interest and ultimately lower the amount of tax payable when the super benefit is eventually paid. What does it look like? Firstly, a super member exceeds their NCC cap in a particular financial year, reflected in step 1. The member receives an access NCC determination and a release authority. The member elects to use the release authority to remove the access contributions and 85% of the associated earnings from their fund. Subject to any restrictions by the fund's governing rules or the fund's administrative procedures, the member can instruct their fund to refund the excess amount from their taxable component first. Commissioner is considering the application of the general anti-avoidance provision in Part 4A to the task arrangement. Now, the third area of concern relates to self-managed super funds directly or indirectly being involved in property development or other business ventures. Now, these arrangements are fine, but we do caution that they may give rise to significant income tax and super regulatory risk, including the potential application of the non-arm's length provisions and breaches of regulatory rules about related party transactions. Now, we are concerned because these sorts of arrangements may be viewed as mechanisms to divert members business-related income into a more tax concessionary environment. By way of example, a property developer, say over 65, commences a super income stream from the SMSF prior to commencement of the arrangement. Due to this, the income received by the self-managed super fund from the development via another entity will be treated as exempt income by the self-managed super fund. All super income stream benefits paid to the property developer are also treated as being income, exempt income in his hands. So if extreme caution is not exercised, there can be significant regulatory and income tax issues can arise. It may cause the fund to lose its compliance status. The trustee could be disqualified, ultimately putting members' retirement savings at risk. We are closely monitoring this area, and we will be engaging with taxpayers whose affairs concern us over coming months. We also propose to publish guidance on the application of relevant provisions where the issues are not already covered by existing guidance, including the application of non-arm's length income provisions as their impact on these particular arrangements. The next matter I wanted to touch on relates to split loan. Now, there's a few rulings that we have put up on the screen there, and these, at a very broad level, relate to loan arrangements where split loans are structured in a way to manipulate the interest components between loans for private purposes and investment loans. These schemes seek to make interest payments on home loans tax deductible. We ask you to refresh yourself about the content of these TRs and tax determinations, because we continue to be concerned that these arrangements of this kind are being entered into again by individuals in an attempt to increase their deductions of their investment interest and ultimately lower the amount of tax payable. More recently, we have seen split loan products, and that's what's reflected in the screen there, where the margin that the broker would normally apply to the home loan is being applied to the investment. This results in interest rates that are outside of market norms. So typically the arrangement consists of a mortgage broker seeking to retain or entice a new customer with a low interest deal. The overall finance offered is $1,600,000 allocable to the principal place of residence and for the remainder to the investment property loan. The mortgage broker is remunerated through a margin, typically 1 to 1.25%. Deal involves offering a $600,000 principal place of residence home loan at an interest cost base, say of 3% with no margin, and $400,000 by way of an investment loan at 3% plus a margin of 1%, adding the margin cost of the principal home loan to deductible investment loan expenses. We are looking very closely at these arrangements, and again, we'll be engaging in discussions with financial institutions whom we have identified as adopting this arrangement. I want to talk now about some of the capital income dichotomy issues that we are seeing in the healthcare industry. Now, in this industry, it's now common for some practitioners to operate from healthcare centres that are run by third parties. The third parties may offer lump sum payments to encourage healthcare practitioners to operate out of their centre. The practitioner is generally required to pay the third party an agreed percentage of the services provided to clients. And this is generally in return for the provision of fully equipped facilities. Now, the lump sum may be expressed to be consideration for the restraint imposed for goodwill or other terms and conditions. There is no issue with the arrangement per se, other than how the practitioner treats the lump sum in their tax return. Now, we have publicly stated our view that generally these lump sum payments are not capital receipts, but are income. And the lump sum will typically be ordinary income of the practitioner for providing services to the patients from the healthcare centre. We formed this view because we say the lump sum is an inducement for the practitioner to enter into the agreements to provide healthcare services from the healthcare centre. We say the lump sum is fundamentally connected to the practitioner's provision of those services. In the alternative, the lump sum payment represents a profit or gain from an isolated transaction in the course of the practitioner providing healthcare services. The mere fact that the payment is a one-off lump sum payment expressed to be principally consideration for the restraint imposed or the goodwill of other terms or conditions does not define it as having the character of a capital C. There is no transfer of goodwill, as a third party operating the healthcare centre does not acquire the right to provide healthcare services from the practitioner. The practitioner does not cease to provide healthcare services. Again, we are targeting activities of any healthcare practitioner who may have incorrectly treated these lump sum payments as capital gains and working to provide further guidance on the issue. Finally, the last current arrangement of concern we want to talk about is unitisation arrangements relating to Division 7A. We are currently looking closely at arrangements which attempt to move profits from a private company to a related non-fixed unit trust in a form that seeks to avoid the application of Division 7A. Now, Division 7A prevents private companies from making tax-free distributions of profits to shareholders of their associate by treating payments, loans, and other credits as a deemed dividend unless they come within specified exclusions. The arrangements rely on overstating the value of the units acquired by a private company in a related non-fixed unit trust to disguise the extraction of wealth from a private company. They vary, but typically will display all or most of the following features. Private companies retain profits. This may be in the form of a UPE from a trust. Private company acquires the units in a related unit trust. This may be done by the company making a payment to the unit trust for the units, or the unit trust issuing the units to satisfy a UPE debt or other obligation of the company. Now, the entities assert that the value of the units issued by the unit trust is equal to the amount paid by the company to the trust or equal to the amount required to satisfy a UPE or pay a debt owed to the company. The unit trust is a shareholder, an associate of, or an associate of a shareholder of the private company. The unit trust instrument contains provisions that results in the value attributed to the units being greater than the amount the private company would pay for the units had the parties been dealing at arm's length with each other. Again, this is an issue we're looking closely at. We've flagged it in our public website as a matter that is attracting our attention, and we are giving some consideration to putting out further guidance to the market on this. So we're coming to the close. I'd just like to take the opportunity to let all of you know that as a tax administrator, we're very committed to helping the community recognise, reject and report aggressive tax planning schemes, and we really value forums such as this as an important vehicle to publish our concerns and assure you that we prefer to deter the activity of promoters rather than penalise participants or taxpayers. Tax alerts and our messages to the tax professional newsroom are also a great source to assist you in becoming informed on particular arrangements. These are also a good trigger for you to report arrangements that are being promoted to the community to help us deal with the problem of stop proliferation of schemes that hurt all of us. We're also willing to engage directly with you to discuss governance of any issue that you think will help you with meeting your tax obligation. So we do encourage you to engage fully with us, especially on these issues, and if you have any doubt about any of the issues in which you are involved in, please apply to us for a ruling or come and speak to us for what we call an early engagement discussion about whether or not some of the arrangements that either you or your clients may be involved in are sailing close to parameters that may concern us. That brings me to the end of my presentation, and really thank you very much for your time and for your attention.